New York all along, actually, all through the ups and downs of the COVID. Yeah.
Welcome to everybody who is out here for this webinar. And welcome Viral as well for this webinar, which is being organized by Mishra Center for Financial Markets and Economy at IIMA Ahmedabad. This, of course, webinar is focused around the last month launched book by Viral, which is basically a quest for restoring financial stability in India. Of course, I'll introduce him to the audience here. But before that, I just wanted to point out that this is something which I think all of you might like to sort of, I got the hold of the book and yesterday I finished it off. Our library was super efficient in procuring it despite COVID times. And I think it is an interesting read for those who are interested in the Indian financial system. So that's the, and second thing which I wanted even before I introduce Viral is to convey on behalf of the publisher as well as Viral that any sale of any proceed from the sale of this book, the author's share, that is Viral's share, would go to Pratham, which is an NGO dedicated to the education, upliftment of education in Indian context, particularly those who can't afford or have problem of access to education system. So that's one announcement. Second thing is, for those who have registered on this webinar, there is a discount which is available at both the Sage India website as well as on Amazon. So this is just upfront, okay. Before I hand over to Viral and before I even introduce him, one thing which I wanted to state is that I would wanted to thank Viral for taking time out and being with us for this webinar. And this is on behalf of the Mishra Center, and I am representing the IIMA, and so therefore this is the first formal sort of welcome to Viral for this particular talk. To introduce Viral, I think most of you who are in India would have known that he was, for slightly less than 3 years, he was Deputy Governor at RBI. He left, I think, in July last year. But beyond that, he was and is still gone back to Starr School of Business at New York University, where he has been Starr Professor of Economics. He is widely published in top-notch journals for those who are having academic interest, such as American Economic Review, Journal of Finance, Journal of Financial Economics, and so on. For those who are more sort of practitioners, he has been instrumental and he's been talking about when he was in RBI about the kind of things which need to be done, which he has kind of captured in the book as well. It's a compilation of his writings and speeches when he was Deputy Governor. What I liked about the particular chapter which he has added, which is not part of his, is the preface, which is about how fiscal dominance in India makes monetary policy, liquidity management, and everything which sort of is done in the financial sector subservient to the need of the government to actually run and sustain relatively large fiscal deficit. So that's something which kind of is theory of everything, which he talks about, which kind of explains the political economy of how the policy making, how the regulators and how the financial markets get affected because of the governmental need to run large deficit. With that, I think I would like to hand over to Viral to talk about the book, his ideas, and what can be done to restore financial stability in India, which has been his primary area of research, which is basically systemic risk of financial sector has been his primary area of research. So the first 40 minutes, I think he plans to give his perspective on a little bit about the book and whatever ideas he wanted to share. And we will follow it up with 40 minutes of question and answer. So those of you who have any poser for him, please use the chat box at the bottom of the Zoom and We will try and pose the questions to him once his talk is over after the first 40 minutes. So thanks, Viral, and over to you.
Thank you, Ajay. I think you have very nicely summarized the primary thesis or the synthesis that I'm trying to offer in the book already. It's always a pleasure to talk to students, hear their questions, answer some of them, ponder over the others, and very often they are actually food for thought for further research. So without much ado, let me start out by raising some questions that kept me up at night during my term. Why are efforts at restoring financial stability seen as contradictory to pursuing growth, even though all evidence points to financial stability being a necessary condition for long-term growth? This is, of course, an observation that can be raised not just about India, but about many, many parts of the world. Why does the central bank, when it seeks to implement financial stability reforms fully and sustainably, always face an uphill battle with the entire system, especially in India? Is there a common undercurrent of resistance which makes it hard to achieve consensus on long-term structural reforms to the financial sector, even if they might just seem like common sense or very basic economic sense? Does the pursuit of growth in India focus mostly on credit-based investment or consumption stimulus, which work in the short run? And is this what causes efforts to restore financial stability to routinely stall, as financial stability often involves incurring short-term pains for long-run stability? And finally, a bit unrelated, but connected, as I will explain, what prevents the central bank from letting it go as far as price setting in the Indian government bond markets is concerned? I want to explain that the uniform answer to all these questions lies in fiscal dominance, which I'll position as a theory of everything in India. What is fiscal dominance? Fiscal dominance was defined by macroeconomists as a state of the country in which large government debt and deficits, meaning the government is spending over and above revenues and financing it with its debt, that it's a state of the country in which large government debt and deficits prevent the monetary policy authority, such as a central bank, from meeting its mandated economic targets, such as inflation, growth, and employment. Instead, the central bank is kept primarily focused on ensuring that the government can roll over its debt and deficits, and in particular, that the government does not default on its liabilities. A more nuanced version would simply be that the government doesn't incur a ratings downgrade, for example. So it need not just be about default, it may just be about avoiding some short-term cliff risk that the government might be facing on its fisc. The central bank becomes willing to accept excessively low levels of interest rate and high levels of deficit monetization, which is that it participates in primary and secondary markets for government debt, or in other words, prints a lot of money and hands it out cheap to the government. And it becomes willing to do so even if inflation is or risks being pushed beyond reasonable thresholds. And the reason why it does so, it's because it loses its focus on inflation and instead starts aiding the government's borrowing programs. Such a state is by and large considered undesirable for the country, as large-sized government debt and deficit tend to be driven by short-term populist pressures, whereas the central bank is mandated to achieve long-term stable objectives for the economy and the financial sector. Fiscal dominance of the central bank can therefore have two adverse consequences, at least two adverse consequences. I'll lay out some others later. First, it prevents the central bank and the economy from achieving long-run stability goals. And second, the central bank, instead of being an independent regulatory institution that can serve a useful checks and balances role in the system on government's excessive borrowing and spending programs, instead it becomes dominated and a facilitator of the government's borrowing programs. Now, what is the point of departure that I'm presenting from the traditional notion of fiscal dominance? My point is that the traditional notion of fiscal dominance is centered around monetary policy. However, when you think about an all-purpose central bank such as the Reserve Bank of India, one should expand the scope of the definition of fiscal dominance. I'm going to generalize its application to potentially all financial sector policies and regulation. Indeed, it was my experience as a central banker that fiscal dominance can induce the central bank and other financial sector regulators, such as the Securities Exchange Board, into adopting a range of suboptimal regulations that compromise stability and macroprudential considerations. Also, unlike the traditional fiscal dominance notion, in which at some point it is in the interest of the economy for the central bank to be fiscally dominated, I'm going to argue that from a financial stability standpoint, fiscal dominance risks crises. And second, fiscal dominance can lead to low productivity and therefore growth traps for the economy. Okay, so those are aspects that are not as central to the traditional notion of fiscal dominance. Now, to just be on the same page, even though some of what I'm going to say is common knowledge, let me just lay out and make a case for why fiscal dominance in India is important and why it has also relevance for the external sector stability. So I'll make 4 points. First, the Indian government's fiscal deficit has always been rather large, among the top 2 in the G20 nations, and by some consolidated measures, in fact, the highest. Much of the spending is incurred due to revenue expenditures, which is sort of various kinds of subsidies and doleouts, and only a tiny share is attributable to capital expenditures or infrastructure development, which are generally considered to have large fiscal multipliers and sustained long-run fiscal multipliers. The deficit composition in India is thus tilted towards short-term economic support, which will boost short-term quarterly or annual growth numbers, but not necessarily expand the economy's pie in the long term. They may, of course, have their own distortions by skewing the consumption basket, affecting market prices, etc. But crucially, the size of the fiscal deficit in India has the potential to accelerate swiftly while serving short-sighted objectives of the government when political compulsions arise. Now, this deficit, of course, depends on tax revenues, so it depends on economic growth. And in India's case, it also depends notably on oil excise taxes. And these taxes become harder for the government to pass on to consumers when oil prices rise, creating a significant vulnerability through external shocks, such as oil prices, in the fiscal deficit of the government. Okay, so that's point 1, that fiscal deficits are large and it has this myopic component to it. It's very dole-out or subsidy-based rather than capex-based. Second, in addition to the large fiscal deficit, India runs a current account deficit so that its imports exceed exports, and that too is heavily dependent on the oil import bill. Barring a few exceptions, such as the most recent quarter when imports collapsed because of consumption collapse, we are always running a current account deficit. So part of India's consumption is regularly financed by the outside world. There is a coincident balance of payments outcome, which is somewhat less appreciated. Among the 3 sectors of the economy, the government, the corporate, and the household, only the household sector in India is saving net of consumption and investment. These net household savings have been steadily declining over the past several years. There are many reasons for this. Besides the decline in real wages, perhaps there is also an impact in the form of credit-based consumption. And it is seen all over the world. As you know, the global financial crisis was caused by such consumption, that when consumers are being doled out cheap credit to consume, they consume far more than when they have to do it entirely out of their own equity or their own wealth. Now, on the one hand, the household savings rate is declining, while at the same time, the dis-saving by the Indian government, which is its borrowings or the fiscal deficits, they are rising. And in fact, presently they are above the level of household savings. So the government on the margin depends on its financing from the rest of the world. The third sector, the corporate sector in India, which also dissaves, is also increasingly reliant on external financing. So that's the second point, the current account deficit and the increasing reliance on the external finance. Point three, these twin deficits, fiscal deficit and current account deficit, make India vulnerable to sudden stops. In a sudden stop, there can be a deterioration in the quality of government or corporate balance sheets, rising inflation either due to domestic stimulus or oil price shock, Federal Reserve rate hikes or dollar absorption, a surge in global risk aversion because of a sovereign default elsewhere or Brexit style uncertainty. In a sudden stop, these kinds of events can trigger a withdrawal by foreign investors who have financed the government and the corporate sector. The resulting fallout in the form of a sharply depreciating Indian rupee, a rise in oil import bill and imported inflation, further widening of the twin deficits, and the debt spiral or loss of investor confidence that ensues create a substantial risk to financial and macroeconomic stability. Such risk has materialized unexpectedly at least once a decade over the past 30 years, most recently during the taper tantrum and the April to October 2018 phase, when the oil prices rose very sharply, along with a rise in domestic inflation. But there are also several minor hiccups in between. If you speak to former governors and deputy governors and macroeconomists in India, they will say that we can't ignore this history, we ignore this risk at our own peril. Fourth, and this is the crucial point, that the government can try to address problems of large debt and deficit structurally. And I'll present some ideas on this towards the end of my talk, which is that they can make adjustments to the level and the composition of the fiscal deficits. But instead, they try to do what is more expedient, which is to economically and financially repress the economy to fund the borrowings. The reason that such fiscal dominance has the potential to affect virtually all financial sector policies and regulations in India is that there are other conflating factors at work. What are these conflating factors? We have strong remnants even today of the pre-1990 era of centralized economic structure and control. These includes also control over regulatory institutions such as the central bank. On the one hand, the overarching presence of public sector banks, other large state-owned financial institutions such as the Life Insurance Corporation of India, as well as non-bank finance companies which are state-owned, such as the Power Finance Corporation, for example. The presence of such entities in large size creates a natural incentive for the government to dominate the central bank and financial sector policies, so that these entities are focused on helping it finance its deficits, roll over bad assets, and so on. This has the effect of skewing the market terms of borrowing against the private sector, and also of distracting the central bank and other regulators from the long-term policy goals. On the other hand, recognition that the government is not at arm's length from the regulators drives what should otherwise be a private sector also into hyperactive lobbying. So the private sector also starts joining the nexus of sort of these relationships. Why? Because they want to engage in consultations with the government and regulators and get their own freebies and lax regulations. And this creates an overall culture in the system of putting in place policies which are very friendly to existing businesses or pro-incumbents. And what they crowd out are market-friendly policies that encourage creative destruction, so failure of defaulted firms and asset reallocation away from defaulted promoters. They crowd out ease of doing business, and they make it very hard for new entry into the established sectors of the economy. Now, this form of fiscal dominance in India is neither new nor unique to the period in which I served at the RBI. Prior to the 2000s, the RBI used to participate in automatic monetization of the Indian government's deficits. Indian government's expenditures used to be financed directly by the central bank, which used to participate in issuance of ad hoc treasury bills. So you basically don't have a market mechanism. There is no price discovery. The central bank buys the bonds or the bills directly and simply hands over the reserves into the government account with the central bank. Now, it was recognized that this is a problem. There's a famous lecture by Dr. Rangarajan, the Kutti Memorial Lecture, that paved the way for institutionally ruling out such automatic monetization through the Fiscal Responsibility and Budget Management Act of 2003. Similarly, in the 1990s, the RBI imposed a very high statutory liquidity ratio on banks as high as 40% and a cash reserve ratio requirement as high as 25%, so that the government remained the preferred, if not the only borrower of bank credit in the economy. The book has a masterful foreword by Dr. Y.V. Reddy, who calls this arrangement as the government, the central bank, and the public sector banks being this happy Hindu undivided family where no one kept anyone's accounts properly. Significant progress has since been made in minimizing such repression of the economy by substantially lowering these requirements since the 2000s. These progressive steps, the FRBM Act and weaning the system away from high SLR and cash reserve requirements, these steps limiting fiscal dominance were undertaken in an economic environment of consolidating government debt and fiscal deficit trajectories, high economic growth, and rise in household financial savings. However, fiscal dominance has once again taken hold of the Indian economy as these conducive factors have gradually reversed. The most striking example is that a recent amendment of the RBI Act allows the central bank to re-enter the primary market for government debt under certain conditions, annulling the reform of 2003 and recreating investor expectations of deficit monetization. Now, why is this a significant macroeconomic and financial stability risk to India? This re-emergence of fiscal dominance with the change in the initial conditions that we have started seeing over the last decade. My assessment is that India was moving away from the nationalized era and that style of organization of arrangements in the financial sector towards more of a private sector based, market based economy. But I think there are undercurrents that we are seeing a regression away from this transformation back towards the 70s and 80s style era. And what I want to lay out is the 5 or 6 channels through which I observed fiscal dominance affecting India's financial stability. I'm going to go through this relatively quickly. In the book, I provide a very detailed map of each of the mechanisms with like micro nitty-gritties of how they actually work, because it's super interesting, unexpected at times, and somewhat surprising that it plays out the way it does. The list is by no means exhaustive, and not all of the channels may be active at all times. But the reason why I've given out a list of these 6 points is because I want to convey that the pressure on the financial sector policies coming from the fiscal constraints is very pervasive and strong. First and foremost, there is pressure on rules for bank recapitalization and regulation. This is the most compromised financial sector reforms in my view. Why? Because we have public sector banks, and if recapitalization standards are raised for them, then it would increase the recap bill that the government has to put up. And this would mean cutting back on some of its populist fiscal expenditures. This typically takes the form of forbearance, regulatory forbearance, relaxed standards for loan loss recognition, protracted schedules for provisioning against realized losses, postponement in switching to modern accounting standards that recognize losses in anticipation rather than only after defaults have materialized, etc. In case of some asset classes during my term, the asset class being micro, small, and medium-sized enterprises, the forbearance is not just a temporary reprieve of a few months, but has become a near permanent feature, with some forbearance being put on the table at least once a year since 5 years in a row now. And this prevents the recognition that the underlying stress of the asset classes may be structural in nature rather than just cyclical. If something is not getting fixed for 5 years with a temporary stopgap measures year after year, you have to do something more fundamental to improve the productivity and growth prospects of that sector. Uh, Equally importantly, when banks remain undercapitalized, the evidence the world over as well as for India shows that they don't lend well. They are risk averse in lending to healthy borrowers. They focus on zombie lending, which is evergreening of defaulted loans or simply extending the maturity and pretending that all is fine. And this way, banks are never in a position to aid economic recovery because they are primarily focused on simply managing their balance sheets to not reflect a manifestation of the legacy problems that they have. Second, default disclosure norms in India are rather weak. In most parts of the world, the securities exchange regulators require that all materially relevant information for the pricing of market securities in equity and bond markets has to be made public immediately by the firms. If you default on a bank loan, this is clearly materially relevant information for the valuation of its securities, because either there are cash flow problems which are permanent, or the firm did not manage its liquidity very well. In India, however, this kind of disclosure on bank loans is not provided. So firms have up to a whole month of delay before such problems come to the fore. Rating agencies don't have this information either. And so at a minimum, there is lack of timely information about defaults in credit assessments by the market and other agencies. Worse, credit ratings may even remain inflated for certain periods of time. Now, why would you think this has anything to do with fiscal dominance? And the interesting, somewhat convoluted chain of events is the following, which is that if firms got downgraded because their defaults are being disclosed, then there would be an increase in the provisioning requirement or the capital that has to be put up by banks. This means the public sector banks would need higher amounts of recapitalization. This would mean that at its annual budget, the government will have to set aside more funds for the entities it owns and should provide for. But because it doesn't want to do that, instead it leans on the financial sector regulations and dilutes a very important form of market discipline and the quality of credit assessments in the ecosystem. So not surprisingly, as former Deputy Governor N.S. Vishwanathan pointed out in one of his speeches, um, recoveries on debt in India are among the lowest in the world, 25 to 30%, maybe with the insolvency and bankruptcy code now, they've gone up slightly to higher levels of 40%. But in most parts of the world, bank loans actually generate recoveries which are on the order of 75, 80%, 90%, and so on. Debt in India essentially looks like an equity contract. It doesn't look like debt contract. We are always finding mechanisms for our borrowers to default and not have to face consequences. And the main reason for this, in my assessment, is that we have these publicly owned finance institutions who, with true asset quality recognition, will have to face higher recapitalization bills. Third and fourth points that I sketch out in the book are monetary policy and market regulations. I will bundle them into one. There is always a pressure on monetary policy to accommodate via interest rate cuts and excessively easy liquidity conditions so that the government borrowing costs remain low. Inflation errors on the downside are okay. Maybe they are even welcome. so that interest rates can be justified to be low, whereas rate hikes and inflation forecasting errors on the upside don't face the opprobrium that a symmetrically charged regulator should face. Now, of course, we have the inflation targeting framework. There is a monetary policy committee with a clear mandate, a very well-designed policy tool, and disclosure requirements. So there are limitations through institutional arrangements. Nevertheless, liquidity arrangements can potentially bypass the control of the monetary policy from the committee directly into the hands of a fiscally dominated central bank. There are also impact on market regulations when interest rates rise, either because the central bank raises the rates due to inflation concerns, or the markets raise interest rates themselves because of either an excessive supply of government paper or because their inflation expectations are rising. Either of these lead to losses on bank bond positions, just the way that interest rate cuts transfer gains to them. However, the accounting treatment of these kinds of treasury gains is asymmetric in India. Gains are passed immediately to the banks because that would aid recapitalization, whereas losses are protracted over a period of time so that the recap bill of the public sector banks remains low. Now, the fact that there are gains and losses, of course, that's natural. What is problematic is the fact that there's a pressure on the central bank to not raise rates because that would transfer losses to the public sector banks. Worse, the public sector banks are always factoring in the central bank put on their treasury bond positions, and therefore they are always keen to buy government bonds rather than lend to the real economy, because they can always rush to the authorities to lean on the central bank to cut rates as a way of actually boosting their treasury gains. Now, this may not be at work all the times, but is certainly one of the pressures on monetary liquidity and market regulation policies because of the presence of public sector banks. I also sketch out in the book that at times when the government borrowing pressures are very intense, the fifth point I stress is that there's a tendency to go for short-term external debt, create pressures on the central bank, which is in charge of external sector stability, to allow for such issuances. But we have seen that this is the most fickle kind of capital flow, as was seen during the taper tantrum. At the time of taper tantrum, foreign money was also coming into treasury bills and short-term commercial paper, and it fled the first during the taper tantrum. And finally, there is always an attempt to raid the central bank balance sheet, so to speak. Now, note that a central bank's profits, whether on the central bank's balance sheet or transferred right away, at some point or the other will go into the government's deficits financing, because it is profits that are generated and will be paid out as surplus at some point. So the question is whether the central bank is provisioning enough equity and reserves on its balance sheet so that it is always perched on the highest hill. The analogy I give is that why was Chhatrapati Shivaji building his forts on the highest hill? Because he wanted it to be very robust to attacks from any side. And in case of India, the central bank needs to maintain large balance sheet, both for its domestic liquidity operations, as well as for being a robust counterparty, which is seen to have a AAA plus rating when it has to support external issuances such as the deposits, foreign currency denominated deposits that were issued after the taper tantrum. Now, under myopic pressures, a government may lean excessively on the central bank to keep transferring these profits upfront, rather than leaving them behind as provisions for the stability of the central bank. And this is a form of coercive monetization of the government deficits. We already have a ways and means arrangement, which is an institution that says that certain temporary liquidity imbalances because of delay in tax collections, etc., can be met by the central bank up to a certain percentage of the government's borrowing programs. However, the attempt of late has been to constantly bypass these institutional arrangements, ask for interim dividends from the central bank, ask for larger and larger dividends from the central
Jai
bank.
Shri Ram.
This is just a backdoor monetization of the of the government deficits by the central bank. Now, there are other side effects of such fiscal dominance, which is beyond the regulatory policies. The corporate sector and the MSME sector in India are crowded out because the banks are stuffed with
Bharat Mata ki
government
jai.
bonds rather than lending to these enterprises. Second, there is external sector fragility because the corporate sector becomes more and more reliant on foreign funds. Corporate sector becomes reliant on short-term financing because there's an oversupply of government paper at typically longer durations. And most importantly, and less appreciated, is that without financial stability being fully secured, monetary policy simply doesn't transmit well to the real economy. Banks are undercapitalized on the one hand, so they are not keen on growing their books. So they are not competing for the new loans as aggressively to pass on the monetary impulses. They are happy to keep their margins very high. But second, on the one hand, there is quantity constraints imposed by the large supply of government paper, and the government is also relying on administered interest rates, such as on the small savings, in order to do extra budgetary resource mobilization, such as for the Food Corporation of India and so on. Therefore, the central bank very often ends up pushing on a string on monetary policy to create growth, but the monetary policy is not as powerful as it could be absent fiscal dominance, because financial stability can't be resurrected until public sector banks are recapitalized. And of course, there is crowding out happening through direct financing of the government through administered interest rates. Now, in the traditional macroeconomic discussion, fiscal dominance is not thought to lead to financial instability because financial stability considerations are not part of the standard macro models. However, in my view, this is actually one of the most important consequences of fiscal dominance. They can lead to crises. They can add to fragility of the financial sector. In my view, such an episode was witnessed during 2018, even though in the end it was managed well by the central bank in my assessment. The episode occurred because the short-term expenditures in the lead up to the national elections created a demand push and caused domestic inflation to rise. Unfortunately, this became coincident with a very significant oil price rise from $40 to $85 per barrel in a short period of time between April to October 2018. So fiscal deficits were widening, the fiscal targets were slipping, current account deficit widened as well, inflation was on a rise, and simultaneously the Federal Reserve was actually sucking out dollar liquidity as a part of the normalization of its balance sheets. And this was a hiccup that had to be managed. But even beyond that, fiscally dominated economies feature poor efficiency of capital allocation by the undercapitalized financial sector. Japan in 90s, the periphery countries in Europe in the last decade are examples of such manifestations. And of course, in India too, we have seen poor capital allocation by undercapitalized public sector banks, even some private sector banks, because there is a race to the bottom in the overall regulations of the central bank because it doesn't regulate public sector banks and private banks separately. And there is favoring of incumbents over new entrants because defaulted borrowers never easily lose ownership control of their assets. These factors, in my view, have slowed down India's transition from a rent-seeking economy to a value-creating economy, at least in the traditional brick and mortar sectors, which are more heavily borrowing dependent. And this has led gradually to an overall loss of productivity and growth. And I worry that if fiscal dominance remains unchecked in the wake of slowing growth, a reduction in the savings rate of the households, then the outcome can in fact end up being a low productivity, low growth trap going forward for the economy. So how can we protect the economy from fiscal dominance and its attendant side effects? And in the preface chapter, I sketch out two tracks. The first is on the fiscal side, and the second track is on the financial stability side. The second track, which is the financial stability side, is of course the core theme of the other parts of the book. But let me start out with the fiscal side, which I do touch upon some of the in two of the final speeches in the book as well. In my view, there needs to be a 5-point agenda for fiscal institutional reforms. And they are required in the midst of COVID, in my view. I think the COVID has only increased the urgency of adopting these reforms because the infection curve is far worse than what we thought it might be at the start of the pandemic's outbreak. Uh, Direct transfers and some other form of relief and repair measures are going to require fiscal expenditures. And how can the government undertake additional fiscal expenditures in spite of the not so great initial condition of the fisc? In my view, this can be done only if the government provides medium-term commitment to getting the debt to GDP and the fiscal deficit numbers back on track. So what is this 5-point agenda? First, a readherence to the prudent FRBM targets. So a fiscal consolidation path over the next 3 to 5 years. Second, a reorientation of expenditure away from short-term populist measures to meaningful long-term multipliers that can be achieved only through health, education, and infrastructure. Third, just having FRBM targets has clearly been shown to be inadequate. So we need objective monitoring of consolidated debt and deficit numbers of the government. This requires, as proposed by the 14th Finance Commission, chaired by Dr. Reddy, but ignored since, an independent bipartisan fiscal council that will hold a mirror to the government's budgets. Every budget should be approved by this council before it is announced at the end of January. Their growth assumptions should be vetted. Are they reasonable? Are the existing deficits properly accounted for? Are extra budgetary resources properly counted in presenting an earnest state of the sort of union budget, so to speak? That's 3, an independent fiscal council. Fourth, improved disclosure standards for government expenditure and deficits, which hopefully the council would require, so that obfuscation of numbers with accounting jugards is precluded. A lot of fiscal planning in India is essentially just fiscal accounting tricks. Above the line to below the line, before 31st January expenditures just shifted right after 31st January expenditures. And they just hide the imbalances, and over a period of time they accumulate to becoming significantly large. And finally, a very significant disinvestment program needs to be undertaken, and these have to be true disinvestments, genuine disinvestments, which are reductions in the stakes of public sector presence in a variety of sectors, including in the financial sector through divestments of stakes in public sector banks, large insurance companies, and so on. Right now, the disinvestment is essentially a residual item. Every year, whatever is the gap in the budget that cannot be filled in spite of the accounting jugards, is just put as a number in the disinvestment row. And then, these targets are either not met, or they are met through coercive monetization by pressure on RBI to distribute its surplus, or they are met through musical chairs being played between public sector enterprises. One public sector arm buys another public sector arm, and the arm that is acquired pays a dividend to the government. how is this acquisition financed? It's through borrowings by the first acquiring public sector entity. And of course, that should be counted as government borrowing because it is with the sovereign guarantee, even if explicit. So that's the fiscal part. In my view, until the fiscal reforms are undertaken, there will continue to be a mission creep on the financial stability side, a persistent pressure to lean on the central bank and other regulators to weaken the norms that are governing the financial sector. On the financial stability side, what is required is that I'll focus on the central bank. First, a firm commitment to long-term financial stability at all points of time. The objectives of the central bank are clearly spelled out as protecting the depositor interests, guarding the external sector, and maintaining inflation stability over the medium to long term. These objectives must be reiterated and reinterpreted on a regular basis to have a truly long-term dimension to resist short-term populist pressures being put on the central bank. Second, independence and the autonomy over regulatory decision needs to be strengthened and enshrined. The Reserve Bank of India Act, as Dr. Reddy explains, is one of the weakest acts on this dimension. And that means that there is always duress because the letter of the law doesn't protect the central bank much. But some steps can be undertaken. Appointments of top management and others governing the central bank should be done in a timely manner and subject to an accountable process that limits the scope for opportunistic placements that can facilitate fiscal dominance. Top management appointments must be for a term length that is at least as long as that of the government, ideally spanning government terms. And top management should be subject to termination only with cause and after a due process, because that can free up their decision making, and it's not then you're not constantly under the gun, so to speak. Regulation, and this third point is very crucial, regulation of the banking sector and other parts of the financial sector should be allowed to be ownership neutral. Right now, the Banking Nationalization Act overrides the RBI Act in its powers over the public sector banks. This needs to be changed so that the central bank can adopt the same measures, replace management, sale, require equity stakes to be sold if capital has to be raised but is not being raised, and so on. Given the substantial presence of public sector banks, the ownership neutrality of regulation, in my view, is crucial for breaking this link of fiscal dominance over financial stability. Third, the central bank can adopt much more policy rules than rely on discretion all the time. So I consider this like, to go back to sort of Homer, this is like Odysseus being tied to the mast of the ship so that he doesn't give in to the calls of the sirens. And that's the value of rules over discretion. So this is adherence to Basel capital and liquidity norms, prompt corrective action for banks that are undercapitalized, default disclosures with immediacy for missed payments, asset quality reviews and macroprudential stress tests so that capital is being provided and assets are being marked on a proactive basis rather than reactive basis all the time. Adherence to the flexible inflation targeting framework, which needs to be perceived with, in my view, when the review comes up this year. And equally importantly, I would say that the central bank balance sheet needs to be maintained at pristine quality at all times. Stress tests can be done on the central bank balance sheet to see what sort of size it needs to maintain to be able to conduct its domestic lender of last resort and the external supplier of dollar reserves of last resort for the Indian economy. Fourth, rather than necessarily taking the view that a central bank cannot dissent against the government, I think the central bank must lean against the winds of fiscal dominance and play the game of chicken. The more easily you are seen to compromise the greater is the pressure tomorrow. Every compromise that you strike today becomes the starting point for the next compromise tomorrow. It's never a ceasefire. The pressures are unrelenting when the short-term populist pressures on the government rise. And in fact, I give the example of Paul Walker, the late former Federal Reserve Governor. He arrested double-digit inflation in the United States in late 70s and early 80s, and was keen to keep inflation at bay, and therefore he refused to compromise monetary policy for cheaper funding of President Ronald Reagan's expansionary manifesto. This episode is now well celebrated because first it was covered in his biography and then in his autobiography. And his stance of leaning against the wind, not giving in to the pressures of the Reagan administration, prevented the US government from undertaking massive tax cuts and incurring significant fiscal slippage, and helped stabilize the government's long-term bond yields, which had started rising because of the expectation of the fiscal stimulus. Fifth, of course, there is room for discretion because shocks such as COVID can arise. But such exceptions and extraordinary arrangements should be done with democratic accountability. The central bank should produce reports that explain in a well-articulated manner what the extraordinary measures are, what the sunset clauses are, so that these are extraordinary or exceptional rather than permanent fixes, and explain what the intended and unintended consequences are, because very often being forced to spell these out will themselves create possibly some embarrassment on certain kinds of compromises and make the central bank think twice whether it should give in to certain pressures or not. And finally, I think it should provide and encourage reason and voice, both internally in the dissemination of its research, as well as putting out concerns, including over fiscal issues. Fiscal dominance can affect financial stability in a first order manner. So if a central bank takes fiscal situation as given, it inherently compromises financial stability because it is not making an attempt to lean against the fiscal pressures that are going to arise. So let me conclude overall with this two-pronged attack, fiscal institutional reforms and reforms to safeguard financial stability. I think we can probably pave the way for a more sustainable, steady long-term growth rate again. If I could quote Federal Reserve Governor Janet Yellen in the end, she remarked famously in January 2009, after the global financial crisis, that a clear lesson of history is that a sine qua non for sustained economic recovery following a financial crisis is a thoroughgoing repair of the financial system. And I think there's an important message there for India. The historical strategy of levering up yet another asset class. So, first you had the traditional sectors, then we went to infra and power, then we went to housing, and now we are going to consumer finance. So we keep moving from one asset class to another to have leverage funded growth. Even before the prior leverage booms bust has been cleaned up, and this is failing repeatedly. It has derailed the Indian economy's long-term growth plans because the financial sector is never in a healthy state. And unsurprisingly, structural reforms are critical now because there is no asset class that is left to lever up any further. So let me end in the hope that this debate on fiscal reforms, financial stability, and their deep nexus actually takes center stage in the coming days. I think that is the need of the hour because we need reforms to be able to undertake the necessary support of growth while maintaining debt sustainability and financial stability over the medium to long term. Thank you, and let me take some questions now.
Viral, I think you have a choice. Either you can pick up the question from the chat or I'll pose them.
Shall I ask you one question? Hello?
I think it might be
While you
better
are quiet.
if
My
someone
name is Dr. While you are
coordinates the
quiet.
questions, because it may become very hard otherwise to coordinate
Correct.
the.
So I would do that, and please feel free to ask your question by writing them down in the chat box in case any one of you feel like asking any question. Okay, so I'll pose I think the last question first, maybe. So suppose if I think the question basically is saying is that even if we were to, let's say, yeah, given the fiscal situation we are in, even if we were to, for example, recapitalize, where would the what would be the where would the money come from? Or where would the kind of thing, if you want to really recapitalize it?
Yeah, yeah. So I think that's a great question. And my view is that we need to kill two birds with one stone, if I could say so. I'm a big bird watcher, so actually I don't like that phrase, but you get the gist of what I'm trying to say, which is that we should get out of the public sector banks, in my view. The healthier public sector banks can be reprivatized. If you look at the history of their privatization in the two waves, as Dr. Reddy summarizes as well, this was basically a political attempt for the government in the center to find foot soldiers all over the country to deliver on its programs, so that it didn't have to work with individual states and so on. I think it has really not worked out terribly well. We might keep saying that public sector banks are needed for development and financial inclusion jobs. But look where their legacy problems are. They are from loans to some of the largest industrial houses of the country. So it's not at all clear that their mandate and focus is what we think they were supposed to do over this period of 50 years that has happened. So I think the healthier public sector banks can be let go in terms of government ownership. They will be able to attract better human capital, raise more capital, raise more financial capital, have better risk management practices, and so on. Now, the weaker public sector banks, this is my second point, even there, the government can let go of its stakes below majority. This was something that the Narasimhan committee had recommended. This was something that the PJ Nayak committee had recommended. But, you know, as is usual, committee after committee, the reforms never get accepted because the fiscal is unfortunately dominating, because they want to own the banks, not pay up for the recap bill, and yet have the luxury of having them available when the short-term compulsions arise. So I think the fiscal situation is such that there is no choice but to actually get rid of these stakes. And we should do it now, because if we wait, as the Southeast Asian countries did, they actually privatized their public sector banks and other firms only after the Southeast Asian crisis. The mop-up cost became 50 to 70% of the GDP, and then they had to sell all these entities at fire sale prices to private equity firms. It would be much better to do it now when the equity market conditions are relatively benign for India, both because of the dollar surplus in the rest of the world and the domestic demand for relatively safe assets, given that consumption has come down and probably there is a lower risk appetite in the short run. And third, I would say, is that these weaker public sector banks that cannot be entirely reprivatized in the short run, they should be, their business model should be changed away from universal banking towards focused development objectives. They can become like microfinance or microcredit institutions, serving exactly the purpose that keeps being given as a justification for their existence in the first place. Look at the small finance banks. Look at one of our largest banks that has come up in the last 5-6 years. They were all microcredit institutions that figured out how to underwrite well, how to collect well, and how to yet make a healthy business margin at the same time. Why can't public sector banks figure this out? It seems it must not be rocket science if some of the private sector operators are able to do this. And this way they would serve the objectives of the financial inclusion and development. They will become better banks, and maybe over time, even these banks can be reprivatized, reducing the exchequer bill. I think there is a way out. I think we keep kicking the can down the road of adopting these measures by leaning on the central bank to keep providing sector specific or across the board asset recognition relief, because then we say, oh, the balance sheet is better than what it is, and the recap never has to be provided by the government. But that's just kicking the can down the road. When growth impulses rise in 18 months or 24 months, will the banks be healthy to lend? No, because they will be catching up on the legacy losses that they've had.
Another question is related to accounting tricks, which you referred to. Basically, the question is there any case, and how do we achieve that, that the whatever is the state of fiscal deficits, including off-balance sheet item, public sector borrowings, is clearly sort of evident because without that, even FRBM possibly will not sort of be of any help.
Yeah, absolutely. I think, in fact, I've said this at one of the RBI meets where analysts were in the room. I'm saying, why aren't the fiscal numbers being put together and studied as on a regular basis? I think this is such an important macroeconomic statistic. So much more research needs to be devoted to putting these numbers together. Now, what has happened is that given the state of the accounts, it is not even possible to calculate a public sector borrowing requirement that easily, because the center and the state have their own borrowings. Then you have to account for the borrowings of the center PSUs and the state PSUs. Now, there is no central authority that is putting out this data in a transparent manner for people to study. Now, if the center, if there is no agency that is doing it, maybe analysts, private sector should actually start putting together this statistic, because it is such an important requirement. There are estimates out there in some of the analyst reports, and some of them study this more than others. But this is precisely why, if I can be very frank, this is precisely why I've written the book. My speeches were already out there, but I've written the introductory chapter because I want the fiscal, the state of the fiscal dominance of the financial sector policies to get a more center stage discussion, so that more resources are devoted all around in the system to actually study these numbers more carefully.
Another question is related to I think what you have covered in the book, Public Credit Registry. And then, of course, the question is framed somewhat differently, but how useful it would be to at least prevent zombie lending and the capital misallocation, which is a consequence of that.
It could potentially be quite powerful because at least there will be public knowledge about who these firms are. Are they receiving subsidized credit? You will know if a defaulted firm is actually getting rollover credit, which is cheaper than a healthier firm in the sector. Analysts can go and study it. They can write reports about it. You and I can write research papers about it. And so, it'll become transparent, and it'll create some pressure in the system to not have these things. The evidence is also that Public Credit Registry is particularly useful for the small borrowers, microcredit borrowers, and individual borrowers. Just think about, say my book got released. I don't have to do anything. There's going to be an Amazon ranking that the book is going to be achieving. Different people can post their reviews that will also contribute to another ranking of the book. In a similar way, a credit score of a borrower should be relatively easy to compute. The borrower does so many financial transactions. They are paying utility bills. They are doing certain financial transactions through their wallets and digital payments. All of these cash flow information can potentially be linked, like GST invoices, utility bill payments, etc., can all be linked with the Public Credit Registry to facilitate easy credit history building. And then actually another collateral benefit could be that maybe our small micro enterprises will realize that there are gains to formalism. See, right now there are tremendous gains to remaining informal, which is primarily that you don't have to pay taxes, you are not visible, you are not on anyone's radar. Once you formalize and once you grow large, you come under the tax net. But what we need is we need to create some benefits of becoming large. and create incentives in these micro enterprises to become large, I think a public credit registry could facilitate it by making it easier for them to borrow. Maybe they could also securitize their account receivables much more readily if there was greater transparency on what is the cash flow pattern on the repayments on these account receivables.
One question is related to, of course, the economic package, but I think from our point of view, we can treat it as the stimulus, monetary stimulus, which was laid out after the COVID. What will be the impact of that? I think I'll just sort of build that question by simply asking, do you think it will further aggravate the problem of zombie lending and misallocation, or do you think it might actually be sort of, given the big balance sheet of the public sector banks and so on?
See, COVID is such a large shock and unprecedented, with sort of also forced economic lockdown, that I think some accommodation made sense. In my view, 6 months debt moratorium is more than adequate. The economy is being opened up gradually in all parts of the country. What is not a part of the package, and this is my continuing lament, is that there is no recognition in the package that there will be losses. Now, the financial stability report of the RBI has come out and given us a stress scenario picture that there could be 12.5 to 14.5% level of buildup in the gross non-performing assets of banks. But there is no capital plan that has been announced yet. Are we using the stress tests to ask banks to raise capital? Are we getting large private banks have already gone to the market and started raising capital? Is that adequate? Do they need to raise more? The small private sector banks which are not yet going, do they need to be nudged or asked to go? What about public sector banks? Are we asking them to raise capital because they will bear some of the losses that are being mentioned in the FSR of the RBI? And also, in my view, the stress test should be applied also to the non-bank finance companies. And wherever required, an AQR plus the stress test should be used to ask them to go to the market and raise capital as well. I think what I'm trying to say is that we can't just keep providing temporary relief without rebuilding the capacity to bear the losses. Without the capacity to bear losses, the temporary relief is just kicking the can down the road. And then you get caught in this vicious cycle that if growth numbers don't revive, then you have to keep doing more and more of that. And the subtle point is that the growth numbers are less likely to revive if you have an undercapitalized banking system, because then it's never focused on new loans. It's primarily focused on managing the legacy loans problem.
A related question, I think, Viral, is that how do you think the suspension of IBC on the banking system, what kind of impact do you think it will have?
In my view, a 1-year suspension is too long. Again, a temporary suspension of 3 to 6 months was probably okay, because everyone has to first deal with the uncertainty of the COVID shock. And why do I say this? Because sometimes people view insolvency and bankruptcy code as punishment. It's not punishment. It is a restructuring of the financial balance sheet of a corporation so that its productive assets can be put back to good use, so that they are not being siphoned off or stripped off, as are very often the incentives of a defaulted borrower who's running an financially over-leveraged entity. Now, such financial restructuring will be necessary both for sectors which were already heavily indebted and now have a further revenue hit, as well as especially the services sectors where not only have revenues shrunk in the short term, but the projections are that things may not normalize actually for an extended period of time. Are we expecting travel and hospitality sector to revive overnight? No. International flying is not actually going to come back to healthy levels anytime soon. In fact, Boeing has estimated that it will take until 2023-24 for international flying and demand to get back to the pre-COVID levels. So this is not something where we can say, oh, a 6-month temporary gap is going to solve the problem. they should ideally restructure their financials. How do you do that? Insolvency and bankruptcy code is a mechanism to do that. How do you do it without risking financial stability? I say when you buy property, the decision is based on location, location, location. When you have to invest in financial stability, it has to be about capital, capital, capital. I think banks have to shore up capital, and I think it should be done on a war footing. Right now, the equity market is benign. This is a golden opportunity to use the benign valuations, whatever demand there is for equities globally and domestically, to channel it into loss absorption capacity of the financial sector.
Well, I mean, a lot of private sector banks have done it. In fact, today was a QIP of HDFC of 10,000 crores.
Yes. So, yeah.
But
I think as is my thesis, I think this will be required even more for public sector banks. And I think what I'm saying as the subtext is that disinvestments from majority stakes in public sector banks should be done right now on a war footing, in my view.
One question is, in the COVID era where fiscal deficit is increasing as a case of necessity, of course, this is all, somebody was asking the question. In fact, this is not true of India, but I guess true globally. So is there a new normal, or you think that they will increase the overall systemic risk in the financial sector globally?
See, the difficulty of the COVID shock for emerging markets is that, we are not hard currencies. We are not safe havens. And therefore, even though the Federal Reserve through its dollar swap lines has stabilized the external sector, as we saw right at the outbreak of COVID, we were also experiencing external sector outflows. In fact, the emerging markets experienced the sharpest 1 month outflow that has been witnessed in modern times. So that is the asymmetric challenge that emerging markets face, which is that safe havens have an automatic stabilizer. Their borrowing costs are collapsing very dramatically compared to the flows and the borrowing costs for emerging markets. In fact, there's a second, maybe less discussed point, which is that inflation in developed economies is very, very low. It's below their mandated targets. This is not always the case in many emerging markets. Our inflation is actually at 6% over the last 2 quarters. Not only is it above the mandate, it is actually beyond the target around the mandate. And supply side cost pressures have a tendency to ratchet up very quickly in less developed countries because their supply side structural factors are often not right. Delivery markets are not as well developed as in the developed economies. And I think this is something that will also be an issue for emerging markets. For a while, it seemed that the oil prices had no floor to crash. But since then, they have once again come back to $40 to $45 per barrel. So, we will have to look out for supply side generalization into inflation. That's kind of another constraint. The third constraint, if I could add, is that the global economy is likely to rebound only in a very unsynchronized manner because the infection curve is at different stages in different countries. China, even though it started there, doesn't have as much of a problem, but now there is some sort of a Cold War brewing against it. Germany, South Korea are doing very well on the health front. That can't be said of United States, unfortunately, because there is a resurgence in California, Texas, and Florida, 3 of the largest states. So there are going to be global headwinds as well to resurrect growth very quickly. So my view is that we will most likely be required to undertake some fiscal measures to support. The support has to be greatest at the lowest end because that is where the burden of a shock like this is felt the highest. Middle class, rich people can cut back their discretionary expenditures, but that's not a significant cost in terms of their overall utility. The highest burden will be felt by those who are really strapped for consumption. And finally, therefore, in my view, it has to be a two-pronged attack. We have to find space for these fiscal expenditures and yet maintain fiscal credibility and financial stability over the medium to long term. And I think we should not ignore that. Otherwise, we run the risk of having another decade of legacy loans problem of the way we've had so far.
Another fozzer is that we have seen examples of private sector bank not being terribly well managed. I mean, I'm just adding on to that. Is it because of the fact that as a regulator, the central bank is not sort of able to be as strict as it would like to be, given the kind of pressures of it, because of fiscal dominance, which you talked about? So that's my
see, my view is that the problems in private sector banks have been more idiosyncratic, related to specific governance failures in individual institutions. There are also counter examples in private sector banks of banks that are extremely well managed and that are now extremely valuable in the market in terms of their franchise. As I was mentioning, a microcredit institution has actually blossomed into a thriving bank over the last 5-6 years. And RBI has the powers when such governance failures happen to replace the management, and it has. And I think these kinds of corrective actions are not possible in case of public sector banks, where actually the incidence of frauds and losses due to frauds is actually far greater than it is in the private banks. So what I'm trying to say is that I'm not in favor of private sector banks over public sector banks, because I'm saying there will never be any problems with private sector banks. In fact, look at the global financial crisis. A lot of mortgages were written with fraud. We had another large bank in the United States where there was mis-selling and creation of false accounts that happened very recently. So there are problems in the financial sector all over the world. The question is whether do you have the mechanisms to correct them? And in my view, the mechanisms to correct the failures at the public sector banks are far and few. Worse, there is actually pressure to relax on them when problems arise, precisely because you don't want to acknowledge the losses. So rather than healing the wound, we actually allow the wound to fester. And I think that is the reason why I'm not in support of continued large government ownership of public sector banks in India.
Another question is related to how RBI and the government can prevent bankruptcies, particularly for the MSME, because of the COVID. I presume that the underlying tone is bankruptcies are bad. So with that,
yeah, so I think I do want to fundamentally raise the question of whether it is necessarily bad. Now, there is, however, one concern that is raised the world over, which is just the way we are trying to flatten the health curve. If the number of bankruptcies becomes very large, do you also have to try and flatten the bankruptcy curve? Because there's evidence that courts struggle when there is a very large number of cases to be handled, because the bench strength cannot be expanded always at as rapid a pace as the filing of cases that is happening. What is the way out? It is possible that some sector-specific direct transfer relief could be provided to some of the most affected services sectors. That would require fiscal capacity. I think it's better to do it directly on the fiscal books, because if it is done through banks, we will get into the trap of doing it without asset quality recognition. And if growth doesn't revive, then this could become actually a financial stability issue down the line.
Abhiman, would you like to sort of ask any question, or you see any question? I'm still scanning through if I think. Maybe actually, one question is why doesn't the government in fact get out completely from the public sector bank? Why even lower the shareholding to a level where it loses control?
I think the reason why I've said that this should be done for healthier public sector banks is because I think some of the weakest public sector banks it may be almost impossible actually to find a decent buyer. And what happens is when you are selling things at very atrociously low prices, you may end up with rogue operators wanting to come in and acquire these banks. Now, of course, due diligences will always be done, but you minimize the likelihood of that if there is actually a demand for the bank that you are trying to sell. Ideally, you want some competition for the bank to be acquired so that through the valuation, you are able to pick potentially the most the buyer who's both willing to bring in more capital and generate the highest value on these assets. So I think it might be better to fix their business model first, put them on a better growth path, and then put them out. You might even, maybe you could even reprivatize them right away once the business model is addressed, because maybe that itself would change the multiple on the bank from the market standpoint.
I think there has been a follow through on the previous question. Is there something called new normal as far as the fiscal deficit is concerned, post-COVID?
For developed countries, the new normal has been changing every year over the last decade. They've also been taking on new deficits. Can we say that that's not a problem? No, because the Europe has had to monetize the deficits of its periphery countries in the guise of, quantitative easing and so on. And are there no consequences of this? There was zombie lending in Europe as well. These sovereigns have not restructured themselves financially, nor have they undertaken in cases like Italy significant structural reforms. And as the Reinhardt-Rogoff evidence shows, this is going to have a sort of dampening effect on the growth prospects of these countries. So I think just because developed countries are able to resort to extraordinary monetary policies or fund their deficits at cheap costs, we should not adopt that as the model. The question we have to ask is, which developed countries have also simultaneously grown well? And I think Japan and Europe don't score very well on that front. United States does. Now, what did United States do differently than Europe and Japan? It also undertook definitive financial sector reforms. It recapitalized its banks. It adopted stress tests so that banks are now actually capitalized above the Basel capital adequacy standards. And it did the Dodd-Frank Act to do a significant overhaul, even if an imperfect, but a significant overhaul of its financial stability framework. I think that is the lesson we need to learn. We need to look at countries which emerged out of the global financial crisis. They did adopt extraordinary measures in the United States, but they also adopted financial sector reforms. And I would say that if fiscal reforms and financial stability reforms are combined, then an emerging market such as India can also, not as a new normal, but as a counter-cyclical measure, undertake fiscal expenditures and yet maintain debt sustainability, commitment, and credibility of growth over the medium to long term.
So I think one question from my side, I mean, you talked about fiscal dominance, I think, which is of course important. The other one is the extractive, which you have alluded to, instead of value-adding businesses. So one can extend the idea that it's extractive forces which are also at work in addition to populist pressure, because, which is manifested in the form of fiscal dominance. So these two put together kind of make sure that we don't have as much change as one would like to see, or one commonsensically would expect to have.
Yes, yes. No, I fully agree. What happens is that they all start reinforcing each other in a very vicious spiral. And I think in our case, it is compounded because of the presence of public sector banks and public sector financial institutions. The reason why I have not stressed overly on the extractive factors and I have focused more on the fiscal dominance and public sector ownership is because when I look at our tech sector, I don't get the sense that this is an extractive sector.
No, that is not.
And so I think that the presence of the debt and the presence of public sector banks which are involved in these debt contracts, and that creates this lack of adequate debt discipline, even lack of a cleanup of the sectors after the debts have risen, seems to me be a crucial factor in in creating incentives to become extractive. And so I think if we can clean up our debt contract enforcement, if we can improve our banks, if we can ensure that time-bound bankruptcy resolution takes place, if we can ensure the financial sector is healthy at all times, so it cares about throwing money after the bad and wants to actually chase good instead, then I think we can create greater value creation, innovation, enterprise also in our traditional brick and mortar sectors, as we see, for example, in our newer sectors like tech and pharma, for example.
Okay. Question is, do you think US policy of tackling unemployment will have consequences to Indian job market? I don't know whether you...
Yeah, I'm not an expert on this,
so,
unfortunately. I haven't seen what is
yeah,
the distribution of the H-1B visas across different sectors. My sense is that the corporations in the US will resist pressures along these dimensions. They value the immigrant labor immensely. And so, we'll have to wait and see. But you can see that even in some of the most developed countries, the protectionist pressures are rising very, very seriously, unfortunately. So I think ideally one wants that the whole is bigger than the sum of the parts, but we are seeing more and more of beggar thy neighbor policies take hold. And of course, it doesn't work to anyone's advantage, because ultimately a lack of adequate trade, lack of comparative advantages being exploited will mean higher inflation and higher costs of goods, maybe not as interesting or as higher quality products for the consumer in the end.
So I think I've run out of stock of questions, at least the ones which are sort of related to the conversation which we had. It was nice having you on this webinar. Thanks, Viral, on behalf of the Mishra Center for Financial Markets and Economy, and I am Nandavan.
Thank you, Ajay, and thank you, Abhiman, for helping arrange this talk for not just the faculty, but also for the students and the alumni. I hope you find some of the discussion, at least food for thought, even if you have a disagreement with some of the stands that I take in the book. And I wish you and your loved ones all the very best in these challenging times. Thank you so much.
Thank you.
Thank you very much.
Thank you, Viral.